Market sell-off continued on Friday with stocks hitting their lowest level since October of 2014. We're off to the worst start to a year ever for the major market indexes. What's ahead, though? Any kind of a bottom, a turn, or more pain? Welcome to Trading Nation. I'm Brian Sullivan. Dennis Davitt of Harvest Volatility Advisors, Katie Stockton with BTIG. Dennis, you're primarily in the options market. What do you see incoming, and what are you doing to maybe get some protection?
Well, what we've seen out of the options market is the lack of expectation of this sell-off that came. Volatility was really muted. Most of the conversations on options trading desks this week up and down Wall Street were about the lack of the performance that we were seeing in the VIX. Now today we're starting to see the VIX go higher, but with the worst market opening in the last 100 years for the month, we're certainly not seeing that in the options space. So, it was underperformance of options leading into the sell-off. But currently, we're starting to see some price in options. I still think options are inexpensive relative to the perceived risk that's in the market.
Okay, so there you go. Katie Stockton, you've been, we were just talking. You've turned bearish for the first time in a long time. Why and how low could this market go?
This is true. So what we've noticed in the past 2 weeks really is a loss of momentum that's more than just short term. Last year was characterized by a lot of pullbacks and not much upside progress, but we really hadn't seen that loss of intermediate term momentum that we now do have. And what that means is that breadth has also deteriorated, meaning that more and more stocks are participating in the down move. It's very much a top-down move. It's a market-driven move, not company-specific, but no less bad because of it. So we have a lot of breakdowns on the charts where stocks are taking out levels where they previously had buying interest, and that includes some of the major indices. We've seen a lot of them fall back below important moving averages and previous lows on their chart. The S&P 500 for one today is testing its August-September lows. I say testing because we don't have that close to judge whether it's a confirmed breakdown, and yet this test of support is very uncomfortable because it is associated with breakdowns elsewhere.
All right, Katie Stockton, very interesting and important chart you're showing us. Katie, thank you. Dennis, thank you. Appreciate it. Very tough year. Folks, thank you for tuning into Trading Nation. We're your stop always now in these crazy market conditions. Be sure to tune in the live version on Power Lunch on CNBC at 2 o'clock Eastern, and also check back here at tradingnation.cnbc.com every day. Thank you. See you soon.
We've been in a near zero interest rate environment for a very long time now, and as a result, dividend-paying stocks have become very popular with investors searching for yield. But this can be a dangerous strategy because stocks not only have more capital risk than bonds. If interest rates should start to rise, these stocks can become some of the most vulnerable to a market pullback.